An auto supplier and a utility top this go around as far as growth and income stock picks are concerned. Our growth and income stock strategist Todd Bunton here to fill us in on why these are on your radar. The auto supplier is Gentex, GNTX, the ticker, right?
Yeah, and they primarily supply the automatic dimming rear view mirrors.
Oh, okay.
Primarily in luxury cars, and their two biggest customers are Toyota and Volkswagen, and their higher end lines are Lexus and Audi. So you'll find them in their very solid growth profile here. The company's consistently generated mid-teens revenue growth. They've seen they've seen expanding profit margins, wide profit margins, and if you look at their earnings momentum, it's very solid. So I brought with me the price and consensus chart, and you can see consensus estimates have consistently moved higher over the last several months, and that sent it to a Zacks rank of 2, which is a buy rating. But as you can see here as well, the stock price has not responded to those positive estimate revisions, and I think part of that has to do with global growth concerns, because obviously they're a global brand now. Obviously North America is a big market for them, but so is Europe, so is Asia. But you can see analysts still expect that strong growth to continue, and actually based on consensus estimates, analysts expect about 25% earnings growth this year and 5% growth next year.
Wow.
And in addition to that, they pay a dividend that yields 2.4%, so you get some income to go along with that growth, and they've increased that at an 8% compound annual growth rate over the last 10 years. And they actually had a 14% dividend increase earlier this year. And they're able to do that because, like I said, they generate very solid, wide profit margins. They have a solid balance sheet with relatively low debt levels, and they're very shareholder friendly. And like I said, they've increased that dividend year after year. I'd expect that to continue over the next several years. And if you look at the price, it looks reasonable. Like I said, the stock price has not responded to the earnings yet. And also there's some concerns. Ford recently issued a profit warning, but that was more for this year. Longer term, everything looks fine. New car sales are still strong, and they're expected to grow here in the U.S. and around the world. So the valuation, it just trades at 13 times forward earnings. Historically, it trades at 20 times. So this could be a good buying opportunity as long as these global growth concerns, are kind of overblown, which I think they are. So this could be a good opportunity to get in and get some good growth and some good income. You
said it twice, the stock price has not responded to the earnings growth. So I have to ask you, is that typical?
No, it isn't, and it's kind of our whole mantra at Zacks is usually positive earnings estimate revisions precede rising stock prices, and like I said, that's usually the case, and you can see that was the case throughout 2013 here. You can, I still have the price and consensus chart here. You can see estimates are rising and the stock price is rising, but those estimates continue to tick up and the stock price has gone down. That's very atypical, and usually it can be a good buying opportunity unless there's a shift in the fundamentals here, and so far I'm not seeing it.
Okay. The utility is actually an energy holding company, Vectren Corporation.
Yeah, they're headquartered in Evansville, Indiana. They serve over 1 million gas and electric customers in Indiana and Ohio. And that's about 75% of their revenues is their utility business. They also have a smaller arm that does infrastructure services, and that's unregulated. That is a faster growing segment for them, so that's really driven the top and bottom lines for them. But the company has delivered very solid results itself. As you can expect, a utility, pretty consistent, pretty steady, and good income, which I'll get to. But if you take a look at their pricing consensus chart, you can see, again, a nice upward slope in consensus estimates for both this year and next year. And if you look at the consensus estimates based on what they're currently at, analysts are expecting about 11% earnings growth this year and 9% growth next year. So that's a very solid growth profile for a utility. Like I said, a lot of that growth is being driven by their infrastructure services segment. But their utility segment continues to deliver solid, steady results too. And as a utility, you'd expect them to pay a good dividend. They pay a dividend that yields 3.6%.
Wow.
And they've actually increased their dividend going back 54 years, which is pretty phenomenal.
Even bigger, wow.
Yeah, but those dividend increases haven't been phenomenal. Over the last 10 years, they've pretty much kept pace with inflation, about a 2.5% compound annual growth rate in that dividend. It's pretty much what I would expect going forward. But still, very shareholder-friendly company here, very good income to go along with solid growth for utility, and all at a pretty reasonable price. They trade about 16 times forward earnings. that is slightly above their historical average of 15 times, but it is a discount to the industry median of 19 times. So, you know, some decent valuation to go along with a very solid, very stable, and very high dividend yield.
Okay. Do you own either of these two?
I do not.
All right. Check out other stock picks and stock picking strategies. You can do that on our website, Zacks.com. If you're not there already and you're watching this video in syndication, all you have to do is get over to the homepage and link to them right from there. In the meantime, with Todd, I'm Terry Ruffalo.